Welcome to MBA Department, NIT Trichy. I am Dr. L. Philo Desirani. I am going to discuss about the topic in financial management, risk and return. After studying this, you should be able to understand the relationship between the risk and return, define risk and return, and show how to measure them by calculating expected return, standard deviation and coefficient of variation. Discuss the different types of investor attitudes towards risk. Then we can able to explain risk and return in a portfolio context and distinguish between individual security and portfolio risk. You can able to distinguish between avoidable unsystematic risk and unavoidable systematic risk and explain how proper diversification can eliminate one of these risks. After studying this, you can able to explain what is meant by an efficient financial market and describe the three levels or forms to market efficiency. Risk and return. Defining risk and return, now we are going to study how can use your probability distribution to measure your risk associated with your investment. And what are all the attitudes towards the risk? The customer may think some is very risk, some is may not risk, likewise. Then risk and return in the portfolio context. How can you diversify your risk and what is the use of capital asset pricing model while analyzing the risk? You can able to understand efficient financial market also here. What is a meaning of risk? First, we have to understand that. That is, what are the income you are going to receive from your investment? That is called as return. These return can be divided into two different headings. That is, what are all the things you can get after your investment, after receiving the investment, and what are all the things, what is the current market price and what are all the beginning and end of the market price of the investment. You can calculate the risk R is equal to dt plus price at the time of beginning of the market minus price at the time of end of the market. Okay, and divided by price at the time of end of the market. So this is the defining risk. Definition of risk. Written example. The stock price for stock A was 10 per share 1 year ago. The stock price is currently trading at 9.50 per share and shareholders just received rupees 1 rupee dividend. What was earned over the past year? That is calculation of risk. Then how can you calculate the risk? See, normally in financial terminology, the risk is not only the part of not only the way return which is going to get very minimum. That is, you are expecting 10 rupees benefit from your investment and you are getting 5 rupees or 15 rupees. That is called as variability of return in that investment. That is the variability of return. The 10 should not be go up to 5 and 50. Okay. What is the rate of return do you expect on your investment this year? And what rate will you actually earn? Does it matter if it is a bank of CD or a share of shop? Okay. You may invest very riskless asset that may be from bank or gold jewelry or real estate or producing a film or going to the stock market. Different kinds of investment avenues are there. But what are going to do? That is the matter. Okay, how much risk you can able to take. Okay, determining expected return. What is the expected return? R is the expected return. It is based upon the risk plus into the probability of getting the return. Okay, if you are multiplying the risk with probability of return, then it is called as determining the expected return. Okay, R is the expected rate of return for the asset. R is the return for the ith possibility. P is the probability of that return occurring. N is the total number of probabilities. How to determine the expected return and standard deviation? So this is your expected return, and this is the probability of getting that expected return, and multiplication of this will give you an expected return. So for this problem, the expected return will be 0.9 or 9%. How can you measure the standard deviation? Standard deviation is the measure of risk. So standard deviation is equal to Ri minus R the whole squared into probability distribution. Standard deviation sigma is a statistical measure of the variability of the distribution around its mean. It's a square root of variance. Note, this is for a discrete distribution. How to determine the expected return and standard deviation? This is why you can do your expected return and standard deviation. This is your return and this is a probability, and this is return into probability, that is expected return, and you can move on to this line. This is the measure of calculating the standard deviation. You may all know very fine before that itself. Okay, so standard deviation for this problem is nothing but 0.1728. Thank you.